Hello, financial mathematics students. Today we're going to be going over the Unit 5 activity, and it's mostly about investing. And we're going to look at some investment opportunities you may have in the stock market and in other types of assets that you may acquire. So hopefully you have the assignment open and we can go ahead and get started. Okay, so let's go ahead and take a look at the very first question here. It says, closing price, past, present, and future. Buying stock gives you a share of ownership of the company that issues the stock. Stock investments are risky because stock prices can fall rapidly if the business suffers a loss or if the stock market crashes because of poor economic conditions. So it's important to thoroughly research stocks before investing in them. Let's say you plan to invest in a company's stock. Choose a company or brand of your choice. You could think of a product such as clothes or a service such as a restaurant that you use frequently to help guide your selection. Research online, find the information you need to answer the following questions. So you can use any company you want, any company that you like, any company that you would be interested in investing in. I would suggest picking a company that is relatively big and relatively stable. So something that's been around for a long time and that has a very low chance of just disappearing, right? Smaller companies, they disappear all the time. You could buy stock in it and then eventually they go out of business, or for whatever reason, they just don't last, or their income is not very stable. So let's go and pick up a very stable stock that we should all be familiar with. And you can find all this information on about any stock you want. You can just go to Yahoo Finance. Okay, so here I am in Yahoo Finance. You can see it here. And the stock I'm picking is Walmart. Now you can pick any stock you want, any company you're interested in. I'm just going to pick Walmart. But keep in mind, whatever thing you choose, whatever stock or company you choose, just make sure that you don't just copy my numbers, because your numbers are going to be different. I'm doing this assignment on the 4th of March, 2022, but these answers are going to be different. Some of these answers are going to be different based on which company you pick and also the time that you are looking, okay? But so the stock symbol, and you can see that right next to the company name, WMT. This is also known as the ticker. Basically, that's the symbol to look up if you're buying a stock generally. Okay, stock exchanges. Oops. So it's listed on the NASDAQ. Okay, the NASDAQ. The New York Stock Exchange, NASDAQ, okay? So, NYSE. Okay. Products and services. So what does Walmart sell? Retail and groceries. Major competitor, you probably already know, Target. Now, for the prices, closing price per share. So most recent, we're just going to look at the current price for the stock. $142.27 or 26 cents. $142.26. What's nice, looks like Walmart's having a very good day today. It's up 2.15%. That's quite a bit for a stock to raise in one day. It's not an absurd amount. Stocks can go up a huge amount in one day or down an even bigger amount in one day. But a 2% increase in a single day is generally pretty good, especially for such a company that's as old and established as Walmart. Okay. Now let's look at the 7 day ago. So you'll notice this chart, and you can kind of look through this chart And you can see on the top, you can click on 1 day. And so these are the price changes just from today. And it has like different times. You can see that. So for example, at 12 o'clock today, the price was at 140.96, right? So it's already increased a lot just from 12 o'clock. All right. And I want you to keep in mind, these are Eastern times. So there's a 3-hour difference. So 3 o'clock or noon Eastern time is actually 9 o'clock Pacific time. So, but these are all today, the change in today's prices. You can see there's fluctuations throughout, but generally it's been an upward trend today. But let's go ahead. You could look at a 5-day. So how's it changed over the last 5 days? But we're going to look at the 1 month here. And we want to look at the price change from the previous week. So from when I'm looking at it, I'm looking at it from March 4th. So I want to go back 7 days. Okay. So that's going to be February 25th, February 25th. 1, 2, 3, 4, 5. Okay. February 25th. You see the price was 136.38. Okay. So you see it's increased even over the past 1 week. Now you want to go, now the next one says 1 month ago. So we want to go 1 month ago is all the way at the end. So that's going to be 139.48. Okay. 6 months ago. So you can see how this works. I would just click on the 6 month, and for the 6 months ago, you just go all the way to the right. Sorry, to the left. So 147.27. So you can see, even though the price increased a lot today, we saw that 2% increase or whatever. That's very good for a 1 day. But you could see it was worth even more 6 months ago. So it's actually decreased in value over the last 6 months. Not by much, by $5, but you can see there is a difference. So let's look at 1 year ago. Whoops, I'm clicking the wrong way. 1 year ago. So you have to click on the 1 year one and go all the way to the left. You can see 129.12. 129.12. 3 years ago and 5 years ago. So we need to look for 3 years ago and 5 years ago. So click on the 5 year one. We want 3 years ago. So we want March 4th, 2019. Okay. March 2019, $97.53. So you can see the price increased a lot from 3 years ago, right? So if you had bought Walmart stock 3 years ago, you would have bought it for $97.53, and it would now be worth $142.26. So that's pretty good. Okay. 5 years ago, so we go all the way out here to the far left, $75.18. $75.18. So that's really good. So if you had bought the stock 5 years ago, you had paid $75.18 for that stock. It would now be worth close to double that. So you almost doubled your money in 5 years. It's pretty good. Remember to keep in mind that owning a stock, and this was mentioned in the first paragraph, means you own a portion of the company, okay? You own a portion of the company. How big a portion? Well, a very small portion. But for each stock that you own a small portion of the company. I wish it told you how many stocks are out, how many shares are outstanding. Let's see. It doesn't say here, I don't think. I know you can find that somewhere, but let's say a stock has 1 million shares out there, meaning 1 million shares of stock. If you own one of those stocks, one share of that stock, you own 1/1,000,000th of that company. So What does that mean? That means you're entitled to 1/1,000,000th of the profit, 1/1,000,000th of everything that the company has. And you even have 1/1,000,000th of the voting rights to decide the direction of the company. So that's some interesting stuff you can do if you own if you own stocks. Okay. Now your numbers will be different based on which company you pick and also how the prices have changed. Even if you pick Walmart, there should be different numbers there. Okay. Part B, use the information you've gathered about the stock to answer these questions. Use the times and corresponding closing prices of the stock to create coordinate pairs. The X represent the number of weeks since the first data point, and then Y represent the closing price at each time. So X equals 0 represents the data point from 5 years ago. There are 52 weeks in a year, and you can write the time for each closing price recorded in terms of weeks that have passed since 5 years ago when X equals 0. Fill in the table to represent the data as coordinate pairs. So 5 years ago, that was $75.18. And we just want to fill in the rest of this chart from the numbers of this one. So I'm just gonna, can I just copy this maybe? Sweet. Okay, so copy and paste, you can put that in there right like that. Now I want to graph this. Okay, that's going to be in the next problem. Okay, open the graphing tool. So question 2, open the graphing tool and select the data tab. So open the graphing tool, it should look like this. And we want to open the data tab. So that's over here. Notice there's X and Y coordinates just like that. So what we're going to do is we're going to use the information that we got right here. And we're going to see if we can copy and paste it into there. Okay, cool. Then you want to plot this graph. Okay. See, can I zoom out? Zoom out. Okay. You can see that this graph looks kind of linear, right? Now your graph will look different depending on what values you have over here. Okay, but you should have a graph, and it says under relationship tab, use linear, exponential, and quadratic function tool with best fit selected to view the regression model. Zooming in and out will help you get a better view of each fit. Observe how well each model fits the data. Rank the 3 function types, linear, exponential, and quadratic, in order from best fit to worst fit. So here's how we do that. So let's go back to here, and we want to go to relationship. Let's first try linear. So let's go linear, and then you would just click on best fit right here. Okay, you can see the data looks pretty good. Like for the line, the data is pretty close to the line. There are some points that are far from the line, but overall, I would say that this looks like a pretty good, the linear model looks like a pretty good model for it. But let's go ahead and let's also do an exponential. And again, we want to go best fit. So exponential is this blue one. Maybe this one's a little bit better. Maybe. It looks like it's pretty close to the linear one. It's not too much different. But you can see it's very similar, right? It's not too much farther from the points than the linear one. It might be slightly better than the linear. It's hard to say. Okay, and then lastly, let's do the quadratic. And again, we want to click best fit. Here this one looks almost identical to the exponential one, right? The orange or almost identical to the linear one, I should say. So the orange, the linear one, and the quadratic one look almost on top of each other. Okay, we can see that there. And we might have to zoom in here. Let's zoom into this spot right here to maybe get a better look. Okay, yeah, very similar. Okay. Now, generally speaking, a lot of times it should be an exponential that's going to be the closest fit. But in our case, it looks like I want to say it's really hard to say which one's the best fit. They all look very, very similar. I almost want to say the quadratic maybe is the best fit, then the linear, then the exponential. But again, yours are going to be different. So I'm going to order mine as first. Mine, the quadratic fit the data the best, then the linear, and then the exponential. Okay. Now yours might be different, but one thing you can do is to show a bit of your work is to take this screenshot here, use my snipping tool, take the screenshot here, and then copy, paste that into here. Okay, it won't let me. What I can do is save that image and then import it here as well. So you would save this snippet and then import it through insert image. So that's one thing you could do to show your work as well. Okay, and you want to basically explain that, well, in my case, I would explain that the quadratic seemed to fit the points the best, the linear equations seem to fit the points second best, and the exponential last in my case. Now, most of yours, I imagine, are going to be exponentials actually probably going to be first, but depends on what corporation you pick and also how their data turns out. So just all depends. Write 2 or 3 sentences justifies your reasoning for the ranking of your choice question 2. So I kind of just already explained that the line that the quadratic model fit the data the best. It seemed to have the closest distance to the points. The linear was second, and the exponential was third in my case. But again, yours might be different. Okay. Let's go and look at part C. So here they give us some data from just some other stock, let's say. Stock values for a certain company are recorded in the table. There's the most recent, and then the values and so on. Okay. Using a process similar to one you used in part B, this exponential model was found as the best fit for the data. So here they have an exponential model that fits this data the best. You can see their model is y equals 30.078 times 1.003 to the power of x. Now, x is the amount of time that's passed, or the number of weeks. Use the exponential model to make predictions about the closing price of the stock. Remember that x represents the number of weeks. I just said that. Since the first data point, so the value of x today would be 260. 260 weeks since 5 years ago. Type the correct answer in each box. If necessary, round your answers to the nearest cent. Okay, so 1 week from today. So 1 week from today, that'd be 261. So what we're going to use is we're going to use this formula, and ideally you have a calculator on you, and if not, you can Google a calculator. But I'm going to do x as a value of 261. So that would be 30.078 times 1.003 to the power of 261. So when we're solving this, make sure you do the exponent first. So we want to do the 1.003 to the power of 261. And then we're going to multiply that by 30.078. Okay, so we would expect the price of the stock to be 1 week from today would be 65.7, rounding to the nearest cent. 1 month from today, so that would be 4 weeks later. So that you'd use 264. So it'd be the same thing we just did, but you'd be using 264 for the second part. And then 1 year from today, it'd be the same thing, except you're adding 52. So 260 plus 52. So for the last one, 1 year from today, it's the same thing, except you're going to be using, instead of this, you'd be using 312. Okay. So I want you to calculate these last two, just like I showed you. And you're going to need a calculator. Okay. Question 2. Do you think the model is a good predictor for future closing price of the stock? Justify your response in 3 to 4 sentences. So it might be a good predictor in the short run, and it's perhaps been a good predictor in the past, but that doesn't necessarily mean it's going to be a good predictor forever, because things don't grow exponentially forever, or at least they don't keep that same exponential level forever. You can imagine that if you kept that same exponential level forever from years ago, and you just continue on for forever, it would just grow to infinity. Okay. And prices of things don't do that. So you might say something like it may follow the model in the short term, but in the long term, in the long run, perhaps many years from now, it will break that model. Okay. And that's a key thing there. I mean, especially if something terrible happens, like a economic collapse or whatever, then suddenly you might see the prices drop dramatically. And that's actually something that happens every now and again. The most recent big economic problem was the 2008-2009 crash, which dropped prices of many stocks and many assets, especially assets in real estate, dropped their value dramatically. Okay, but let's go ahead and read this next section. We're on page 6, portfolio choices. Many investments are part of a larger investment portfolio. So a portfolio is a group of investments, So you may have investments in stocks, some investments in bonds, some investments in real estate, some investments in all kinds of things, right? So whatever you have investments in, these are essentially part of your portfolio. And how you decide to put your funds into different things creates your portfolio. Ideally, you want a diversified portfolio, meaning you don't put all your money into one asset. For example, if I just put all my money into Walmart, maybe it'll do great, but maybe if something bad happens to Walmart, like for example, there's a huge lawsuit that Walmart has to pay, or some really bad news comes out about Walmart, or anything can happen. So if I have all my money in one investment, then something bad can happen, and in that case I would lose a lot of money, potentially all of my money. So that's something to keep in mind. Walmart's usually pretty safe. I mean, it's been around for a really long time, and it'll probably be around for a long time in my future. So that's probably fairly safe, but even still, you want to diversify so that you're not putting all your eggs in one basket. Okay. This unit explored how to diversify your portfolio to help reduce overall risk. Recall the 6 types of diversification below. So we can read these types of diversification. So individual company diversification. A strong portfolio includes a mix of assets from different companies in a given industry. Industry diversification. Consider stocks and companies from a variety of industries. This strategy includes buying assets in unfamiliar industries. I would stay away from unfamiliar if it's too unfamiliar, okay? Invest in things that you understand. I would say that. We all understand Walmart. They sell stuff, okay? We understand that thing, but if you don't understand how the company makes money, that's something you really want to consider when you're deciding whether to add an asset to your portfolio. Okay. Asset class diversification. Invest in different asset classes such as stocks, bonds, and real estate. Strategy diversification. Diversify strategically by investing in different assets with an asset class. For example, a diverse portfolio includes stocks from small and large companies. Geographic diversification. A specific economic region can't give consistent results, so invest in a mix of domestic and international stocks. Okay, have some companies from European companies or Asian companies, some domestic North American companies, because if something bad happens to the U.S. economy, generally that means the whole world economy is something bad is going to happen. But if you're diversified, then that risk is lowered. Okay. Time diversification. Invest in different options considering the investment time period and risk tolerance. For example, long-term investments are less risky and often give better returns than short-term investments. All right, part A. The table lists a variety of investments along with their purchase costs and a description of their expected gains. Note that because the cost to purchase includes fees, this cost is higher than the initial purchase amount. So we can see all these various types of investments you can do. The first one mentioned is a European stock index. So it follows a stock index, which is a group of stocks, basically. You can see in this case, the time horizon is 1 year, and it grows at 15.99%, and the initial purchase is $3,000. Notice you have to pay $3,270 because there's like fees and stuff. Okay, U.S. Treasury Bond, $612. That's what you'll pay today. What you get is you get 2.75 annual interest rate for 30-year term on a 600 purchase compounded annually. And you can see the rest of these other investment options that you have. Okay, so we're going to try to build a portfolio that's diversified from these given different assets here. Okay, so let's first start with a domestic stock. So it has to be a stock from the United States, a US company. So what can I pick here? There's quite a few here. Fidelity, Blue Chip Growth Fund. Okay, Investment Company of America Shares. Okay. Vanguard Small Cap Index Fund, Admiral Shares. So you can see there's different ones. Adidas shares. So this is owning a portion of that company, Adidas. Okay, let's just go ahead and pick this. Let's just go ahead and pick this Adidas here. So we're going to do the investment name, which is the you could choose one of the other ones if you want. The cost to purchase was $122.11. And the pre-tax expected return says 1 year expected growth of 2.64% on initial purchase of 115.11. Okay, so what we would do is basically to calculate this, you would do 115.11 times 0.0264 to the power of 1. Let me actually show you some of that math. Okay. So this is for our Adidas, that's this one. Okay. So it would be 115.11 times 1.0264 and to the power of 1 times 1.0264, 118.15. Now, this may seem like a bad investment because we paid $122.11 and we're getting back after 1 year 118.15. Perhaps this is a bad investment if you're only holding on for 1 year. But generally, you would hold on to a stock, I would suggest, for at least 5 years, because in 1 year, it doesn't really show the growth, really. Holding on to 5 years is generally much better. Let's go ahead and take a look at this next one we're going to pick. It says a foreign stock. And for that, you can invest in this one, for example, Alibaba, which is I believe it's a Chinese tech company. Again, you want to diversify depending on not just the type of fund, but also the location, right? Some foreign, some domestic. This stock costs $3,100. And the return, 15% expected return, 10-year period on initial purchase of 2,833. So let's go ahead and do the math here. So we would do 2,833. And this time it's a 10-year, 15%. 1.15 we're going to put here to the power of 10 goes to the power of t. Now you're holding on to this stock, not selling it for 10 years in this case. So we would expect this to be a good return because we're not touching it for 10 years. We're just leaving it in there. And indeed, a 15% return is very good. So what we do is we do the exponent first. 1.15 to the power of 10. That gives us 4.0455. And then we multiply by 2,833. So this gives us 11,461. 11,461.07. Round to the nearest cent. Okay. Now for a bond, you can choose any ones that say it's a bond, basically. There's this Roe Price International Bond, or you can do a U.S. Treasury Bond. U.S. Treasury Bond is usually considered the safest investment you can really make because you're always going to get your money back with the U.S. bond. The only way you wouldn't is if the U.S. dollar just basically disappeared and the U.S. government just disappeared, in which case we'd all be, there wouldn't be any good money anyway. So U.S. Treasury bond is the safest asset that you can have, and you can see, but because it's so safe, it doesn't offer a very high interest rate. You can see 2.75% annual interest for 30 years. So you have to keep it in there for 30 years, and you still only get the 2.75%. Whereas if we do a more risky bond, like investing in this company here, then we get a much higher interest rate. Notice we don't have to keep our money in there for long, this time only a 10-year term, and we get a much higher interest rate, 3.97%. Okay, so the cost here is $107.95. And the expected return, here you get 3.9%, 3.97%, 10 years, $100 purchase. So we do $100. This one here. 1.0397. And we're doing to the power of 10 since it's a 10-year bond. A bond just means you're lending money to a company. In the case of a government bond, you're lending money to the government. So treasury bonds are government bonds. Okay, again, we do the exponent first, then we multiply by 100. That gives us 147.60. Now for the other, I'm going to let you do that on your own, but let's see what you can pick. You could just pick any of these that you want. Okay, just pick one more that you like, and that goes into the other. Okay. Now, use the pre-tax expected return on your investments and the cost to purchase to find the profit of each investment. So we're going to use these same investments, whatever you picked here, and I'm going to copy, and I'm going to paste. The total cost to purchase, so I'm going to use my cost to purchase. Copy. I'm going to paste. Pre-tax expected return. Copy. Paste. Profit on investment. So your profit is a very simple formula. It's however much money you made minus however much money it costs. Okay, so for this first investment, it's actually negative. So your profit here was actually negative. So you would do your whatever much money you get return, 118.15 minus 122.11. So I've got negative 3.96. Is that normal? Yes. Yes, that's completely normal. Some investments are bad investments and you're going to lose money. That's part of the risk. If it wasn't risky, then everyone would do it, right? But part of the risk is that some investments are going to actually lose you money, okay? But that's okay because we have a diversified portfolio. Hopefully we made money in other locations. So let's go ahead and take a look at the next one. So again, the return minus the purchase. This one was a big winner for us. $8,361. And whatever your other one as well, do that one as well. And then you would do your total. So you would add these together and that'll give you your total. Don't forget to do this row as well. Whatever you picked for your other investment, make sure to put that data there and calculate this total on the far right. So you'd add all this total column together. Which investments in your portfolio, if any, do you consider to be short-term investments? Explain your answer in 1 to 2 sentences. So short-term investments means basically it's a year-long investment generally, or even shorter, okay? So sometimes you have some short-term investments, but ideally most of your investments should be long-term. I would suggest whatever stocks you buy, you should hold on to them for at least 5 years, okay? So any stocks you buy, you hold on to it 5 years, and almost if you made good decisions and you have a diversified portfolio, then you're gonna almost certainly see a good return. So which investments in your portfolio, if any, do you consider short-term investments? In our case, we have this one short-term investment, the shares of Adidas, because we only hold on to it for a year in this scenario, okay? If you picked another short-term investment here, meaning you only hold it for like a year or two, then you would put that also into short-term investments. Which investments do you think would be the most profitable to keep long-term? Explain your answer in 1 to 2 sentences. So which investments were the best long-term? Well, the ones that give you the greatest return on your investment. You could see when I look at these percentages, some of these give really high percentage return, right? Look at this very first one, 15.99%. We should have picked that one, right? Because look how good that return is, right? Other ones give you not so great returns, right? Like the one we picked for Adidas, only 2.64%. Okay, that's why it ended up being not a positive investment. Okay, look at the Vanguard, this market index here, 15.95%. So you could see some of these are better investments than others, right? Now, if you have especially if you have a very high return rate, you want to keep those long-term because that interest gets compounded, meaning you'll get that interest the first year, but then you'll get interest on top of that interest the next year, and then on top of that interest the next year. This is what exponential growth is, okay? So if you have a diversified portfolio, especially if you have quite a few investments that earn large returns like this, nearly 16%, that's great. And you want to keep those as long-term as you possibly can, because those are going to continue to compound and earn you a good return. Okay, so any investments that you pick that have a very high interest rate, you want to keep those long-term. Okay. And generally speaking, I would say hold on to everything for at least 5 years before you decide to sell. Which investments are riskiest, or what would be watched the closest? Explain your answer in 1 to 2 sentences. Now, the things that give you the highest return rate are the riskiest assets, okay? That's why they get such a good return, is because they are risky. There's a chance that you won't get that return. There's a chance that you'll get nothing or even lose money. So generally, the riskier the asset, the more the return has to be for you to be willing to invest into it, right? So that's why some bonds, like this bond right here, offers a better percentage than the US Treasury bond, because US Treasury bond has less risk. So which of these are considered the riskiest? Well, the ones that have the highest percentage are going to be the riskiest. And generally that's stocks. Stocks are going to give you the best return on your investment for the most part, but they are also the riskiest. That's why we don't put all of our money into one stock. It's better to put our money into multiple stocks across multiple industries and across even multiple countries, because that diversification means that even if you've got a couple of losers, you're going to have, since you're so diversified, you're going to have enough winners to make up for that. So any of those stocks, those are risky investments generally, okay? Anything with a high percentage of return, the reason they have such a high return is because they are risky. So try to answer this last question based on the returns of the investments and also the fact that they are stocks. Stocks are more risky. Okay. Well, with that, I hope that all made sense. Try to answer all the questions in your own words. You can use some of the stuff that I say, of course, but if you could add a sentence or two and make it your own, then obviously that's the best way to do it. Okay. Now, if you have any questions, feel free to put them in the comments section below, and I'll try to answer whatever I can. Well, with that, thanks for watching and have a great day.